Good day to Mr. Ali, my fellow classmates and listeners. I'm NATHIYA of AV SASITHERAN from Group 5 Slot B, and I'll be presenting on Chapter 14 about the financial auditing and investing process. We will be explaining the audit of selected assets accounts in this video. Assets accounts are classified into three types, which is prepaid expenses, intangible, and property, plant, and equipment. While the audit approach for each category is similar, there are differences between these three assets account categories. The materiality of account balances differs between account receivable inventory and prepaid expenses for many entities. Prepaid expenses, deferred charges, and intangible assets are common. Substantive analytical procedures are used to verify account balances. Other assets are listed in most financial statements. And in most financial statements, there are accounts referred to as other assets. A prepaid expense is a common type of asset. Prepaid expense also include prepaid insurance, prepaid rent, and prepaid interest. Prepaid expenses such as prepaid insurance have a lower inherent risk because these accounts do not involve any complex or contentious accounting issues. Furthermore, any errors discovered in previous audits will be insignificant in money terms. Prepaid expenses are usually handled during the purchasing process. The effectiveness of control activities in the purchasing process is used by auditors to assess control risk for prepaid insurance transactions. Control activities in the purchasing process, for example, should ensure that new insurance policies are probably authorized and recorded. Controlling insurance transaction and information may necessitate the use of additional control activities. Control might also be maintained over the systematic allocation of prepaid insurance to insurance expenses. Entity personnel should prepare a journal entry at the end of each month to recognize the expired portion of prepaid insurance. In many audits, the auditor can gather sufficient evidence of prepaid insurance by performing substantive analytical procedures. The purchasing process is tested for transactions. Tests of prepaid insurance balance are only needed when misstatements are expected. Prepaid insurance accounts typically have few transactions, so substantive analytical procedures are effective for verifying the account balance. To test prepaid insurance, these procedures are used. First, test of a detail of the prepaid insurance. Test of details of balances for prepaid insurance and the insurance expenses may be necessary when the auditor suspects misstatements based on prior years' audits or when substantive analytical procedures indicate that the account balance may be misstated. The accuracy and completeness of this schedule are tested by putting it and tracing the ending balance to the prepaid insurance account in the general ledger. Then, the auditor's job is test the existence, completeness, right and obligation, valuation, and disclosure classification assertions. Second, existence and completeness. by sending a confirmation to entities insurance brokers and requesting information on each policy's number, coverage, expiry date, and premiums. The auditors can verify the existence and completeness of insurance policies included in the account analysis. Third, right and obligation. You can find out who the policy beneficiary is by asking this information on the confirmation that sent to insurance brokers or by looking at the insurance policies. Fourth, valuation. The auditor wants to know if the amount of prepaid insurance that hasn't been used and thus the cost of insurance is right. Fifth, classification. The auditor is worried about classification because different types of insurance not being put in the right accounts.
Auditing intangible assets refers to the assets that provide economic benefits for longer than a year but lack physical substance. So the type of intangible assets is artistic, things that are protected by copyright. Then marketing. It includes trademark, brand names, and domain names. The third one is technology, both patent and unpatented technology. Next, we have customer. It includes customer lists, order backlogs, and customer relationships. Lastly is contract. It includes license, franchise, and broadcast right. Some intangible assets are amortized over time, while others like broadcast license, trademarks, and goodwill are considered to have indefinite life and are not amortized. However, all intangibles must be reviewed for impairment at least annually as well as on interim basis.
Now, we are going to discuss about inherent risk related to intangible asset. To recap, our goal as auditor is to consider the inherent risk, control risk, and then set up a detection risk so that we can consider how much substantive testing we need to do for the inherent risk and control risk thing that are in the company control by the business that they are in and the control that they put in related to the risk of that business. The inherent risk is the risk that you could consider removing the control and focusing on the inherent riskiness of those items without the control. Now, when we think about intangible asset, they can cause a serious risk consideration, and again, you will list some of the items here, but of course the fact that they are intangible and they are going to be on the balance sheet that we are reporting as value as asset, and they don't have physical substance. It can be a little bit difficult for us to basically verify, test, prove the value of this thing. So, risk can be great because accounting rules are complex and transactions are difficult to audit. It is not as easy to audit this kind of contract that arise from this intangible asset. They can be quite complex in some cases. Accounting standards require different asset impairment tests for different classes of intangible asset. So when we think about the asset on the book, keep in mind that what we want to do from a regulatory standpoint is to record it at cost or mark it down if it has been somehow impaired in some way or possibly depreciate. If we talk about something like PPE, so that impairment that we are worried about is something being recorded on the book as an asset and being overstated. Of course, we are more concerned with the asset overstatement when we discuss things that are not tangible. Then it becomes riskier for us to know when something is overstated or not, and hence we have these various asset impairment tests that will be seen. You could see more detail about those type of tests with the FASB ASC topic 350. Obviously, this type of issue will be specific to the specific type of intangible asset that are going to be owned by specific type of company. If we are talking about companies that have movie right or something, like clearly they are gonna have some special area and we can go into those type. If we have others company like has a trademark situation or some type of technologies that is going to be highly valued and it is being recorded as highly valued, we want to make sure that it is being properly recorded as well. Auditor frequently assess the inherent risk as high given the factor listed above. So we might say the risk factor in this area are high. When we observe this intangible asset, we often consider the risk to be high if they are likely to be material factor in the financial statement. These are the items we will want to look into. Now, we are going to consider the control risk assessment. So, the control risk refers to the type of control that will be implemented. As auditor, we want to be able to rely on control to some level if possible, and then evaluate the substantive tasks once the control have been considered. The control relevant factors are related to their skill and experience in estimating the fair value of asset. So, when we think about this intangible asset, it truly depends on who estimate the value of this intangible asset, how the value of this intangible asset were recorded on the book. Again, this may differ depending on the type of intangible asset, but we want to know where this intangible asset came from, who came up with the calculation, and how it was recorded, so that we can consider if they have the experience and expertise in order to do the proper type of calculation related to them. Control over the process used to determine fair value measurement. So we want to control over the people who are in charge of purchasing this type of thing, such as intangible asset, and the people who have the valuation, who will be calculating the valuation of them that are going to be on the book. We want to basically have those two things, a segregation of duty there as an internal control factor, the extent to which the entity engage and employ valuation specialists. So we have a certain type of intangible asset. Again, if we are in the movie industry or something similar, we will need specialists to get in there and determine the value of this intangible asset, and we want to know to what degree that people are relying on and who the specialists are that are applying the valuation of this intangible asset. We want to consider any significant management assumption in determining fair value. So, whenever we consider something, if an estimate is involved and there are basically assumptions within the valuation process, that might be a place where there could be problems. Of course, we want to have some understanding of what the management assumption would be with regards to valuation. We also want to consider the integrity of change control and security procedure for valuation model and system.
Test of details in substantive procedures. Tests related to valuation and impairment of intangible assets are often necessary because the complexity and degree of judgment increase the risk of material misstatement. Substantive evidence is required for all significant accounts, and substantive analytical procedures alone are not generally enough to provide sufficient evidence for significant transactions involving intangible assets. Sessions considered for test of details includes existence, valuations, completeness, right and obligations, and classifications.
Proceeding to the next subtopic, auditing the property management process. For most entities, property, plant, and equipment refers to the amount of material in the financial statements. Therefore, if the audit is an ongoing engagement, the auditor is only required to focus on current year's activity because the assets acquired in the earlier year were subject to the audit procedure at the time of acquisition. Other than that, the size of the entity may also affect the auditor's approach in plant, property, and equipment accounts. If the entity is relatively smaller with less asset purchased during the year, it is more cost-effective for the auditor to conduct the substantive analytic procedures and direct tests on account balance. While for larger entities, auditors are likely to have formal procedure for budgeting and purchasing capital assets. Therefore, there are four types of property, plant, and equipment transactions that may occur, which are the acquisition of capital assets for cash or non-monetary consideration, the disposition of capital asset through sales, exchange, retirement, or abandonment, the depreciation of capital asset over their useful economic life, and leasing of assets. Next, this table shows the overview and flowchart of property management process. Large entities usually use the IT system to record and process plant, property, and equipment, where it is easier to maintain the subsidiary records and produce the required reports. Using the IT system, transactions are periodically entered both from purchasing process and direct input into the system. The property, plant, and equipment master file will then be updated accordingly, and the periodic report can be reviewed to ensure the proper recording. The subsidiary ledger is used to record all the capital assets owned by the entity, where the ledger includes the cost of asset, data acquired, method of depreciation, accumulated depreciation, and lastly, depreciation expenses for the financial statement and income tax purpose. While the general ledger is used to reflect all the transaction and expenses by property, plant, and equipment. On the top of that, auditors are required to have control on the risk assessment of property, plant, and equipment by following the substantive strategy when auditing. Auditors should focus on major assertion, key control activities, and tests of controls that relate directly to the property management process. Other control activities that related are discussed as a part of purchasing process, where occurrence and authorization, completeness, and the segregation of duties are involved. Firstly, the control risk assessment under occurrence and authorization. The control activities for the occurrence and authorization normally is a part of the purchasing process. As for large entities, some specialized technical equipment is more likely to be purchased after passing through a specific capital budgeting process. Therefore, auditor may need to check more documents other than invoices to test the validity of the asset. Additionally, most of the entities have some type of authorization table based on the size of capital asset transaction to ensure that the authorization to purchase capital assets is consistent. Control activities should also identify the assets that are no longer used in the operation, and all the major maintenance or improvement must be properly authorized by the appropriate levels of management. Secondly, completeness. Most entities use software to maintain the detailed record of accounts, especially regarding to the property, plant, and equipment. Control activities used in the purchasing process to ensure completeness and provide some assurance on the recorded capital asset transactions. It is a procedure to ensure that this assertion meet the periodic reconciliation of property, plant, and equipment from subsidiary ledger to general ledger. Another control activity to ensure that the capital assets are recorded accurately is periodic comparison of the detailed records in subsidiary ledger with the existing capital assets. Physical examination may be limited and not reliable for the larger entities. Another control activity to ensure that the capital assets are recorded accurately is periodic comparison of the detailed records in subsidiary ledger with the existing capital assets. Physical examination may be limited and not reliable for the larger entities. About the segregation of duty, the existence of accurate segregation of duty for the property management process depends on the volume and significance of the transaction process. Table above show the example of segregation of duty for the property management process and possible errors or fraud that result from the conflicts in duty. Following is the inherent risk assessment for property management process. The starting point for assessing this risk for property, plant, and equipment is the assessment of inherent risk for the purchasing process. The risk factors that classify as operating characteristic and need the consideration by auditors are complex auditing issue, difficult to audit transaction, and misstatement detected in prior audits. Firstly, the complex accounting issue. There are few types of property, plant, and equipment that involve complex accounting issue, which are lease accounting, self-construct assets, and capitalized interest. For example, in the case of lease transactions, auditors need to be aware of the complex lease accounting standards and make sure that the audited entity has proper implementation of these standards. This is because the complexity of property, plant, and equipment accounts, it is common that such transactions are accounted incorrectly by the entity itself. Secondly, the difficult to audit transaction. Most of the additional property, plant, and equipment are relatively easy to audit as it is purchased directly from the vendor with purchase evidence. However, transactions that involve donated assets, non-monetary exchange, or self-construct assets are difficult to audit. The presence of this type of transaction will lead to a higher inherent risk assessment. Lastly, the misstatement detected in prior audits. If the auditor have detected misstatement in prior audits, the assessment of inherent risk will be higher compared to the fewer or no misstatements from the past. For example, in prior years, auditors found numerous misstatements related to the cost for valuing self-construct capital assets. Auditors expect to find out more misstatements in the current year unless the company establishes new controls over the cost accumulation. Therefore, this misstatement will set a higher inherent risk.
As mentioned earlier, when the number of transactions is small, auditors often follow a substantive strategy when auditing property, plant, and equipment. Therefore, a detailed discussion of the substantive procedures for property, plant, and equipment is provided next. Here are examples of substantive procedure. First, compare the prior periods, balances, and depreciation expense with current periods. Second, compare the ratio of depreciation expense with prior years. Third, compare the ratio of repair and maintenance expense with prior years. Fourth, review capital budgets and compare the amount spent with amount budgets. Fifth, compare the ratio of insurance expense with prior years. Then, let's talk about the tests of details of transactions, account balances, and disclosures. The assertions to be considered and common practice are provided below. Completeness and accuracy are discussed first because the auditor must establish that the detailed property, plant, and equipment records are accurate and agree with the general ledger account. We usually obtain a lead schedule and detailed schedules for additions and dispositions of assets or examine a sample of assets and trace them into subsidiary ledger. Second, valuation and allocation. Examine the vendor invoices and other supporting documents or use CATS. Third, existence. Obtain a listing of all major additions and watches them to supporting documents. Obtain a schedule of all major dispositions and verify that the asset was removed, or examine the lease agreements. Fourth, classification. Examine selected expense accounts or examine each material lease agreement. Fifth, rights and obligations. Examine the vendor invoices and other supporting documents. Examine or confirm property deeds or title documents. 6. Cut off. Examine a sample of vendor invoices or inquiry entity personnel and review last transactions. Finally, how to evaluate the audit findings. Actually, process for evaluating the audit findings for property, plant, and equipment is the same as others. If the likely misstatement is greater than tolerable misstatement, then the auditor can say the account is not fairly presented. Then either entity adjusts the financial statements or auditor issues an unqualified or adverse opinion. If the likely misstatement is less than tolerable misstatement, then the auditor can get the conclusion the account is as fairly presented. In addition, the auditor should document his or her conclusion as to whether the aggregated misstatements cause the financial statements to be materially misstated. Thank you.